Our view is that right now is a great time to be invested in innovative, impactful companies that are driving positive change. And I'll explain to you why we think this at the moment. We think that a lot of the macroeconomic variables are coming together, creating the perfect environment for a strategy like ours. So in terms of macro conditions, the most, I guess, talked about factor or variable has been inflation and interest rates. And as many of you might remember, back in 2022, there was a lot of talk about elevated inflation continuing into the future, and perhaps there's a debate about hyperinflation and that being sustained. Our view has always been that those trends were going to be temporary, and over the long term, we're going to see declining inflation rates, and an investment style like ours would come back in favor. And that's exactly what's happened. If we look back to 2022, the reason why we thought that that was temporary was because a lot of the factors that drove up that high inflation, we saw to be temporary. So things like supply chain disruption, the fiscal stimulus, the high prices of commodities, the incredibly high goods demand, labor shortages was another one. These were all COVID-19 pandemic-related issues that we felt would mean revert in the fullness of time. Under those conditions, investors were best placed to invest in low-quality cyclical companies that were not necessarily driving positive change. There was enough high nominal GDP growth and inflation to sustain returns in some of those lower quality cyclical companies. But our view was always that over the long term, these trends of declining birth rates, an aging population, high debt levels, and technological progress and increasing inequality would drive nominal GDP growth rates lower and inflation rates as well. Back then, it was hard to see what exactly technological progress would be. But of course, today, with ChatGPT and AI front of mind for everyone, we can see the productivity gains to come from that technology and to drive down nominal GDP and inflation through productivity. Under those conditions, we believe that investing in innovative growth companies taking market share is the right way to invest, and that is exactly what we are doing. So let's have a look at where inflation is going. Back in 2022, you can see that inflation hit a peak of 7%, and this is US core CPI. And since then, it's been gradually coming down. But the really interesting thing, we think, is that the median inflation number is now back to below COVID levels. And it's only a handful of CPI lines that's holding up that overall number. And our view is that those handful of outliers are finally coming down. So we are going to see a lower overall CPI number in the months and quarters ahead. What are those handful of items that's holding up inflation? Well, it's shelter and motor vehicle insurance. They're the two line items that's really been holding up the overall CPI numbers. But in more recent months, we're finally seeing those items break down. So if we then look out into the coming months and quarters, our view is that the overall CPI is going to trend lower, making it easier for the Federal Reserve to cut interest rates. And that then has implications for investing. So the Federal Reserve's got a 2% inflation target. The overall inflation at the moment is over 3%. But if we look at the last 3 months, we're annualizing at just under 2%. So that suggests to me that we're already at that 2% target. And if we can see those two line items of auto insurance and shelter coming down finally, then that overall inflation number can trend much lower. So what does that mean? We expect, or the market expects, the Fed to cut the interest rate twice this year. And our view is that when they do that, the bull market that we've seen, or the strong equity market that we've seen, will start to broaden. And as I'm sure everyone knows, although the US market has been strong, it's been driven by a lot of the technology companies and not necessarily the other companies listed on the market. And of course, as sustainable investment manager, a sustainable investment fund, we're focused on areas like renewable energy, healthcare, and the like. So, some of those investments have lagged the market for us, but our view is that that is going to turn in the coming months and quarters. I also want to raise here that we are seeing some weakening in the U.S. economy, and our view is that a weaker U.S. economy is actually good for equity markets, and that's because it gives the Federal Reserve more of a green light to start cutting interest rates. But the data that we're seeing out of the U.S. is definitely showing a slowing of the U.S. economy, but it's not breaking, it's not crashing. So, which is a great environment for equity markets. The last data point on employment, for example, showed that unemployment rate actually increased to 4.1%. So, the employment market is slowing, but it's not crashing, which is good. As I said, the probability of a rate cut is, as of a couple of weeks ago, is at 99%. So it's near certain that the Federal Reserve is going to cut interest rates, and that's going to have ramifications for the market. We believe that as the Federal Reserve cuts interest rates, we believe that that's going to be good for impactful investing, for markets that are in sustainable areas. So one area is in electric vehicles. These are quite simple rationales, but when we had high interest rates, it impacted affordability for cars. So, a couple of years ago, when interest rates started going up, and given most people buy cars through finance, it really affected their affordability. And it also came at a time when we're in the midst of supply chain issues coming out of COVID. And that meant that car prices were really, really high. So we're at this intersection where car prices were really, really high, and interest rates were really, really high as well, which then had a double impact on affordability. Now, as interest rates start to reverse lower, affordability starts improving. And also, as supply chains ease, the price of cars is also starting to fall. And we're seeing that in that CPI data coming out. So I said before that auto insurance is starting to fall. Well, auto insurance prices is only starting to fall because car prices are starting to fall. So we expect car affordability or auto affordability to improve, and more specifically, electric vehicle affordability to improve in the quarters and years ahead. Another area that we think that will benefit as interest rates come down is in the fintech space. So, here's an industry or sector that really suffered as a result of high interest rates because people were concerned about the credit quality as interest rates increased. Now, as interest rates decrease, we expect the credit quality and concerns to alleviate. And so companies like Mercado Libre and Nubank, which are delivering financial services through technology in Latin America and driving economic growth to many of the population that don't have access to financial services, we believe that they're the types of companies that are going to do well in the coming months and quarters and years. Another area that we're really excited about is in renewable energy. So again, as interest rates increased, these are very capital intensive industries. And so as interest rates increased, it impacted projects negatively, and a lot of the stock prices were affected accordingly. So, and on top of that, you had a lot of supply chain issues coming through, which then meant that the development cost of many of these projects far exceeded the initial estimates. and the profitability of these developments were compromised. And so a company like Ørsted, for example, is down 60 or so percent from its peak a couple of years ago. So we think that as interest rates start to decline, companies like Ørsted will start to improve in the quarters and years ahead. I'll now talk through some key holdings and provide you with some insights into the way we look at investments. The first one I wanted to talk about is Pro Medicus. And, we analyze companies obviously on their sustainability metrics, but also we tie it back to valuation and the business fundamentals. And so I thought that a chart like this would help explain our investment rationale and paint a picture of where we see the investment today. So in the blue line, we have the EV to sales ratio. So a very simple 1 year forward short-term valuation metric. In the orange line, we've got the forward price earnings ratio. So again, another metric looking at profitability and value, or profitability versus price. And in the purple line shows the profit margin, and the green line is the stock price. And so we were invested in the company from back in early 2020. And so, our ANZ funds really benefited from the strong performance of this company. And for those of you that don't know, Pro Medicus provides a software solution enabling radiologists to view scans on their device, and it allows hospitals and clinics improve productivity because of the functionality of their software offering. And it's a highly scalable business. So as the company's grown, the conversion to revenues have increased, profits have increased, and so has cash flows. So it really is a fantastic company from a fundamental perspective. And we've seen profit margins increase from 35% back in 2016 all the way up to close to 70% today. Now, that we expect that strong growth and margin expansion to continue in the future because their product is only 10% penetrated or so of the total market. So we think there's a long runway that the company has. But you can see that the valuation is elevated. You look at the short-term forward earnings numbers, and you can see that pretty clearly. It's trading at the upper end of the long-term range. But the interesting thing about Pro Medicus is that they do have that AI optionality and upside. So the company is investing in that area, and has a product which is going to help clinicians better diagnose patients using this technology. So we don't think that optionality is included in the price yet, and that's the opportunity. However, we can see that the valuation today is elevated. So what we have done is we have started selling down some of the position, but it still is a large position for us, and we're still excited about the long-term potential. And the reason why we haven't sold all of it is because we know that only a very few companies actually outperform over the long term. And so when you are onto a company that is delivering tremendous value, the important thing is to hold on to it and stay invested for the long term. The other company I wanted to talk about is Fisher & Paykel Healthcare. This is also another large position in our ANZ fund, and it has a history of steady growth over the long period of time. So we saw that, really from 2015, we've seen steady growth in profitability and also stock price. But of course, they sell respiratory products into hospitals, and during COVID, experienced significant revenue growth and significant margin improvement. But as the vaccine became available, the COVID-19 vaccine came to market, hospitalization rates decreased, and subsequently revenues started to decrease. And so from 2020 to about 2022, we saw this declining stock price, declining margins, and declining profitability. But if you look at the long-term success of the business, our view is that that trend will continue into the future. And if we look at the valuation, it's not too far away from where it has been in the past on average. So our view is that, well, margins are depressed and that eventually will mean revert back up. Yet the profitability or the valuation based on short-term earnings is not elevated and within reason. And so we are comfortable owning a large position in Fisher & Paykel Healthcare. Now, we spoke about the short-term benefit that the company had in getting those extra revenues through COVID, but there is a long-term benefit the company has enjoyed, which we believe will play out slowly over the long term, and that is just better awareness of their product. They've always found it difficult to raise awareness within other departments of the hospital, but thanks to the strong growth that they had in during COVID, a lot of the hospital purchasing officers and clinicians now know about Fisher & Paykel, now know about their product, and their awareness has increased significantly. And so if we think about the long-term potential, our view is that the company can now sell into new departments much easier, and the conversion will be much better going forward. And so we've actually been buying or increasing our weight into Fisher & Paykel over the last couple of years, taking advantage of that opportunity. Position in the global fund, we've got a large position in NVIDIA, and the rationale from a sustainability perspective is that AI has benefits in terms of productivity, but of course in areas like healthcare and education can drive a lot of positive change. But before any of that can happen, we need the infrastructure, and that's where a company like NVIDIA comes in. The investment thesis was that there's about $1 trillion of CPUs, which is the traditional semiconductors that are used in data centers, that's going to be needed to be replaced with GPUs, which is the graphic processing units, in which NVIDIA has a significant market share in. And so our view is that over time, all the CPUs or most of the CPUs are going to be replaced by GPUs, and NVIDIA has about an 80% share in GPUs. When we look at the numbers, we can see strong revenue growth to continue for NVIDIA. But as you can see, more recently from 2022 to 2023, NVIDIA's margins increased significantly from 26% all the way up to 56.6%. And that's obviously on the back of fixed cost leverage and strong revenue growth. Now, if we look at the valuation of the company, yes, the stock has done really well, but we can see that earnings has done really, really well as well. So from a valuation perspective, it's not necessarily more expensive than what it was prior to this surge in stock price. We can see from the orange line that the price earnings ratio is in line with historical levels, but the EV to sales ratio is probably up on the upper range of the long-term average. So that is really reflective of the fact that the company has been able to drive sales higher and convert those sales at a much higher margin. Now, the question really is whether those high margins will continue into the future. And given historically, these semiconductor companies have experienced a lot of cyclicality, there's a belief that there's going to be a mean reversion of margins back down. Now, what has changed, however, is that NVIDIA is producing or has a software solution as well, and is able to add value to their clients in other ways, and really pivot the business or migrate the business towards more of a software type business, enjoying high margins and recurring revenues. But of course, that is happening at a time where we're seeing elevated margins, and there is the likelihood that margins will revert despite the software opportunity ahead, because ultimately the most of the revenues and profits are still coming from the sale of GPUs. And so what we've done is that, we had about a 10% weight in NVIDIA, and that's come back down to about 6% over the last couple of months. That's just about risk management of our portfolio, and we've deployed some of that capital into areas that I spoke about before, being in renewable energy, electric vehicles, and the like. Mercado Libre, which is a company that I mentioned before, is a fintech company operating in Latin America and driving positive change by delivering financial services to the Latin American market. And so this is a company that we've started downweighting NVIDIA and investing in companies like Mercado Libre as well. Our view here again is, if you look at the blue chart, we can see that the EV to sales ratio is depressed over when compared to the 10 years. Yet the margins, they're coming back up from a pure point of unprofitability back in 2019, back up to over 18%. But because of the high interest rates that we've seen over the last few years, our view is that in that margin number is embedded the impact of high interest rates, and the impact that has on consumer sentiment. And so as interest rates start to fall, a company like Mercado Libre, we think, will benefit as consumer confidence increases, bad debts decrease, and transactions increase. Despite the elevated levels of inflation and interest rates that we've seen over the last few years, the company still has delivered strong returns, strong revenue growth, strong profit growth, and we think that once the macro environment improves, that's only going to get stronger. Ørsted, it's a renewable energy company, the leading offshore wind developer in the world, struggled over the last few years as interest rates have increased as a result of higher inflation rates. And they were commencing on a lot of big projects over the last couple of years when they locked in a tariff at a certain level. But of course, as that development continued throughout the end of COVID, where they experienced supply chain difficulties, high interest rates, the profitability of those developments really suffered, particularly in the US. And so they've had to impair their assets in the US and redirect their capital. It's been a period of capital misallocation over the last 4 years or so. But if you look at the fundamental business, and if you look at their existing assets, primarily in Europe, we see that there's a lot of cash generation and strong returns in the developed assets. And when you strip out the capital misallocation that took place in the US and around the world, outside of Europe, the asset base is very, very strong. And so there's been a change in management here at Ørsted, and they're refocusing the business on their core markets and right-sizing the business accordingly. And so we believe that the business is turning around. And if we look at the valuation, here's a leading renewable energy developer trading at historical low valuations at a period where we see the need for renewable energy developing increasing. They are the leaders in this space, and so we expect strong growth for them to continue into the future. And we can see that margins are also trending higher finally now as well. So here's a company in which we started off with a small position back in 2021 because the valuation looked stretched to us and the expected returns weren't there. We saw that the impactfulness of the company was very compelling for obvious reasons. But now we believe that the the long-term investor returns is now finally there as the prices come down. So just to summarize, here are some points. We are focused on investing in the high quality companies positioned to take market share that are also driving positive change. We've got a strong track record. We run 2 portfolios. Both are high conviction strategies, but we do that because we believe that's the best way to drive positive change, but also to generate strong returns.